lot of those will go out of business. I mean, if you look at the number of zombie companies, for example, in the Russell 3000, you'll find there's more than you think. I mean, it's probably 1 out of 6, 1 out of 5. And those companies are probably gone. I mean, they can't get financing because if you don't have any revenues or any earnings, it's going to be very hard for you to get financing. I think that's what you're running up against.
Our next guest says that we are heading into a recession, but it won't be as mild as what the Federal Reserve is projecting it to be. So how bad will this recession get? What's going to happen to our economy? What will happen to the unemployment rate? Which sectors will be most affected? What will happen to the stock markets? And what should you do if you're an investor and perhaps even a small business owner? Ted Oakley joins us today. He is a founder of Oxbow Advisors, and he has the answers. Ted, welcome back to my show, the David Lin Report. An honor to host you as always. Thank you for being here today.
Thanks, David.
All right, so you were telling me offline that you disagree with the Fed on the notion that a mild recession is coming. Well, a recession is coming, but it's going to be a little bit more than mild. Their words are always up to interpretation. So how would you interpret the message, and what do you think they're not getting right?
Well, David, of course, we don't know what's going to happen. I'll have to say that first. But I think if you look at everything deteriorating right now, it's hard for us to see how they could ever end up with just a really light recession, because you're coming from a place where everything was just in bubble territory. And so you have a tremendous amount of leverage. I could go through a lot of things that I don't think the Fed is noticing because they don't really watch Main Street as well as they should. But if you just look at the extreme inverted yield curve, that's always been a really good indicator of a deeper recession. I think that's where we are. We'll have to see, but it's rare you have a really light recession when you get it like this.
Certainly the earnings, at least so far this week, have shown resilience in the economy, at least in quarter one, particularly from the tech stocks. Do you think that this is just backward-looking data and perhaps next quarter's earnings are going to be much weaker?
You know, one of the things I've noticed right now, David, is that, you know, if you look at the big three names that are half the S&P this year, you know, Apple, Microsoft, NVIDIA, you know, they've had good numbers, are going to have good numbers, I think, and when it's all said and done, and that's had a big impact on what people think. But if you look underneath, okay, those earnings are not quite so great. And I think that's what people miss. This market right here reminds me so much of the first quarter of 2000, when the big hitters in the S&P were still showing okay strength in earnings and various things, but it was right before they had to check in with some reality.
But can you elaborate on that a little bit more? So underneath the hood,
if you look at all these big tech names, they've done a couple of things. They're cutting expenses, and they're cutting people. That's one of the ways that they're pushing forward. I think, that if you look at what's happening with them, and this will happen. I mean, their ad revenues and that sort of thing will slow down and a lot of these things. And then the second thing, and Amazon mentioned it yesterday, that they think that their cloud revenue is going to be soft. So I think in general, if you look at all of this, they're the last ones to go. Usually your major leaders in a market are the last ones to go. And what happened this year is people rushed right back in and bought them because that's all they knew the last 10 years, see? But those will be the ones in the end that probably suffer the most because they're the most overowned. So when people get scared, that's what they sell.
What's interesting to me is that credit card balances have continued to go up if you look at data from the St. Louis Fed. I presume that people were buying the things that have made the earnings report on these companies so good with their credit cards over the last quarter. And some people have speculated that this can't go on forever, especially with interest rates at elevated levels. The Fed may pause rate hikes later this year. We'll talk about that, but probably rates won't reverse anytime soon. So all that to say is that people's credit card balances are high. People can't afford to keep buying things forever when their savings rate has been low. What do you think is going to happen the rest of the year in terms of consumer demand and consumption?
Well, David, I pulled a graph yesterday that showed basically all four age groups that are working age, and something around 55 to 58% of each group really were living paycheck to paycheck, week to week, on top of that. And so they're running the credit cards. And what this stuff usually does is they keep They keep on spending as long as they can, as long as they can. And then all of a sudden, got a 2-earner family and one of them loses their job. Okay, then the lights are out. It's that sort of thing that happens. We're not there yet. I mean, we're not to a point to where, and that's why they're watching employment. When employment sags, then you're going to really see, that's the last thing. That's when you start to really get hit.
One of the reasons I like talking to you is because not only do you look at the data, you've got decades of experience. And so usually when I talk to somebody with a lot of experience like yourself, they usually give answers based on their gut. What is your gut telling you right now about how the markets are going to perform for the rest of the year?
Well, I don't know. I can't give a timing note on this, but I would say that I suspect, okay, and that's what we think will happen. As earnings decline and deteriorate, which we think they will over the next three quarters, that as that happens, people have to readjust what they think that the markets are worth, and so they trade lower. So we really don't feel like that October low was the low of this cycle. Had it been the low, we're sitting here in May almost. Had it been the low, we would be moving right now. I mean, big off a market low, and that hasn't happened. So I think it's caught a lot of people where they're hoping, they're trading for hope, but we don't see it in the pricing, and we certainly don't see it in the companies we want to buy that are priced where we want them, even though they're getting there.
So you think companies are still too expensive now, despite overall PE levels of the S&P coming down?
I do, and if you look at these big companies now, between the buybacks, which have been big in the quarter, still first quarter, I don't agree with buybacks. By the way, it's not my favorite. And secondly, if you look at, how they let, and unfortunately, powers that be have let these companies get away with all these adjustments to earnings so they don't have to follow GAAP earnings. So they can add back, adjusted comp to people. They add those back. A lot of things get added back that are really not helping us at all as shareholders, but they look okay when they have, when they have their conference call. And I think that sort of thing, those things like that, will go away as the market gets worse.
And do you think, Ted, that the markets have been grinding higher since late last year because they were anticipating either continued economic growth, or do you think they were pricing in a Fed pause, or do you think that generally markets are just complacent for some reason? What is the main reason you would pin this rally on?
Well, the first part of the rally, which it always happens this way, David, in January, you have all the new money that comes in for pension plans, 401ks. Everybody gets their bonuses. All of that goes through the system. And you typically do get some market move in January based on that, which we did this year. And then people, I think, want this thing to be over so badly. I've never seen such a drive toward trying to catch the low, and nobody's patient right now. I can tell by just watching things, but they should be, because they can get a lot of money short term in Treasury. So they're not patient right now, and they're trying. There's no saying out there that to be too early is to also be wrong, and I think people have to be careful with that, because that's where we are right now. I think they're trying to make this work. We just don't think it's going to.
Well, let's talk about interest rates now. It's very interesting how a lot of people are predicting not just a Fed pause, but perhaps a Fed pivot. Let's talk about that first, and I want to talk about some implications for certain asset classes. Do you think the Fed will pivot, which is to say that they will cut rates sometime this year?
Well, I think what is on their mind is that they don't want to get in a situation. I'm speaking about the chair now, and I don't know the man, so I can't say anything about that other than personal opinion. But I think what he knows enough to know that Volcker, when he first started, raised rates, and they laid them off a little bit, and then it came, and then inflation, it came back stronger. Inflation did. I don't think he wants to make that era. So I think, in just personal opinion, I think he would probably keep them maybe higher. He may not go higher, but he keeps them high until they really know they've got the system where it ought to be. And they would not have it at where it ought to be if they turn right back around and lower the rates, because then everybody's right back in the game, and that's not going to work for what I think their long-term goal is.
I think a lot of people have been comparing Powell to Volcker, not because Powell raised the interest rates to double digits, but he did raise the interest rates high enough such that inflation came down. Is this a fair comparison between the two?
Well, it's two different times. For one, we have this tremendous debt, government debt, leverage all over, everywhere. We didn't have as much government debt and that kind of leverage as when Volcker was there. And secondly, I think it was one of those times when times were different then, and inflation had been around for a long time and been around really for 10 years. So we haven't had it that long. So it's hard to compare the two. I think he does see this, though. If he loses the battle in here and loses the lifeline on this inflation, then it'll be really hard to get it back in the bottle. And I just think he's thinking that way, and I may be wrong, but it seems that way.
The markets are priced in the Fed rate increase by 25 basis points. At least the probabilities are skewed in that favor. Let's assume the market's right. We get one more. Is that it? And then we're done? Or do you think we're going to get more?
Well, one of the things that's happened is it's been ornery on getting the prices where he wanted them. So, I think that's coming whether he raises or not. But I don't know about that. I guess he could do it again in June, a quarter. Once you get to where, getting a 5 1/4 funds or 8 1/4 prime, like that would be, another quarter really doesn't make any difference because these borrowers are paying a lot of money. And a quarter is not going to make any difference because they're already in the hole at that point.
Ted, one of the concerns that people have is how are companies going to be able to afford refinancing at higher rates? A lot of companies, small and big in the United States, have been borrowing on low interest expenses or low interest rates from the previous cycle, and now their debts are up for refinancing or are about to mature. What's going to happen, you think, next year?
A lot of those will go out of business. If you look at the number of zombie companies, for example, in the Russell 3000, you'll find there's more than you think. It's probably 1 out of 6, 1 out of 5. And those companies are probably gone. They can't get financing because if you don't have any revenues or any earnings, it's going to be very hard for you to get financing. I think that's what you're running up against. And then all of a sudden, you've got all these other areas coming here too. Real estate has a lot of money that's leveraged up, that's rolling. You have so much pressure to borrow. And I just don't think they have room for that. And I think one of the things we're seeing with the banks, particularly the regional and community banks, is it's a different game for them now because when real estate was they're loaned up in real estate. 2/3 of all their loans are real estate. They were big loaned up. They'd do a commitment that's, let's say, for $10 million. And by the time you got the apartment building, say, part of the way through, they'd maybe use $4 or $5 million. They sold it, paid the line down, and on down the money. Now those lines are fully drawn at 90, 95%, and there's no buyer on the other side. So they're going to have to refinance that loan. So that means for a new loan, they won't have much room to move. And that's the problem you're running into here.
So the issue is that they can't even get another loan, is what you're saying. What about those companies that are able to, I guess, qualify for refinancing or get another revolver? One of the arguments is that they have to then raise their prices, jack up their prices by a tremendous amount to be able to keep their margins up. And that in itself is going to cause inflation. It's the cost added theory of inflation. Do you think companies are even in a position, given our economic environment, to be raising prices into next year?
I don't think so. I think a lot, I'm not every company, there's a lot of them can, but if you look at, I know in the last year or two, people are saying, hey, commodities will never go down, never go down. Well, commodities are going down this year too. And all of that factors into a situation where it'll be hard for them to raise prices. I'm sure some of them can. There's certain things that people are going to buy no matter what. But in general, I think it's going to be really hard for them to do that.
So when these zombie companies go bankrupt, and you said there's quite a few just in the Russell 3000, what's going to happen immediately? The immediate impact on our economy? Well, first there's going to be layoffs, I suppose, and then what?
Well, I think there'll be what I call the Great Reckoning, and that is where all of these people have been living off, something for nothing. All right, and there's a lot of them. A lot of these companies, a lot of the crypto, all of this stuff, leveraged real estate. They were playing in a playground that was easy to run. And now they're going to have what I call the Great Reckoning. And that's happening now and probably over the next 2 and 3 years, where they're going to have to be able to do something to shore up the equity side for whatever they're doing. It doesn't make what the asset class is. That's where I think they're going to have the problem.
Seems like every few decades we get a great reckoning, right? What you're describing now, the over-leveraged system, especially in real estate, that happened in 2007. Yet I guess people either don't learn, or the new generation haven't learned, or they don't want to learn, or just interest rates being so low make it irresistible to avoid. I don't know. What is this, just a inevitable cycle in our economy?
Well, I think it is when everything gets in bubble pricing. And it's interesting to me in the commercial real estate, Ben, because I think real estate's a great investment. But I'll say in the commercial side, particularly commercial buildings, that sort of thing, most of the people in the industry think, oh, it's just a little glitch and everything will be okay. I don't think so. If you look at '07, like you mentioned, that went toward subprime, but that went toward mortgages, et cetera, et cetera. This one, I think, will go toward commercial real estate. I think it will really drive that hard, which will mean the prices will come down. And one other thing in that end of things, I'll just tell you, and this is something over the last 7 or 8 years, David, banks 15 years ago or 20 years ago would make you have really other collateral or good collateral when you put up a loan. And you'd have to sign personally on a lot of those loans and different things. Everything, because of competition the last 7 years, all these banks went out and did non-recourse. What happens on something like that when times get really bad is they show up one morning and hand them the keys, and then game's up. So I suspect there'll be some of that before it's all over.
I've been hearing that commercial real estate is going to do well. Why is that, Ted? I thought that people going back to the office, or new mandates for people returning to the office, are going to be good for commercial real estate. No?
Well, if you look at it, yes, it should be. And a lot of them have come back. But I think the other side of it is that the companies that are coming back have downsized to a degree. I know here in Austin, we've had 2 or 3 tech companies downtown here that have really given the space back to sublease. That's the problem. If you don't need as much, and they were fat and happy with so much money. A lot of these companies, that they were just taking down space with not thinking about it. I think you just overbuilt. Same way with apartments. You're going to overbuild this whole thing, and that's where we are right now. A lot of space coming on in the country.
All right. So tell us about your fund. I know you have several different strategies. Tell us about one of these strategies, and I guess your most overweight sectors, or the asset classes that you prefer the most, given your outlook on the economy and the stock markets.
Well, our greatest overweight right now is to treasuries. We have 3 strategies: a really conservative, stocks on another one, and in the middle, we have what we call a high income strategy that doesn't have bonds in particular, even though we own a lot of treasuries. But in all 3 of those strategies, our overweight is to short-term treasuries. We're probably 55 to 60% in all 3 of those. If we find something we like, we buy it. And we've made some purchases, the last month or 2, but they've got to hit the numbers we want before we'll buy them. And we just haven't had that many companies hit it. We've had some, but that's our biggest overweight. We obviously own, a number of stocks and a number of bonds. We've moved out and we pushed about 10 to 15% of the bond portfolios out to the 20 year, 20 to 30 year, because we think that those rates are finished, as far as maybe not coming down, but not going to go any higher. So that's sort of the way we're structured right now.
Let's talk about bonds. Let's assume that the Federal Reserve stops raising interest rates later this year, perhaps even pivots. What's going to happen to the fixed income portfolio if interest rates go down? That's bullish for bonds, no?
Well, it is, and I think a lot of damage has already been done in the bond market, so people are sort of stuck. They can't do anything. We were fortunate. We had a lot of short-term liquidity, so we didn't really have much damage at all in 2022, particularly relative to the 10-year bond. But what I think will happen is people, then they'll start running for yield. What they should be doing now is taking some of that short paper and doing 2 things. We think they need 10 to 15% of it on a lockdown, 20 to 30. And then also they need to start looking at 1 year, 2 year, 3 year, even 4 year paper. So when that Fed does come along here and stops raising or lowers, they at least have some protection for the next 36 to 48 months. And I think people are forgetting that, because I've seen this before. I saw it in the early 80s when they're getting a lot of money short term. Like right now on our floating rate treasuries, they're 5.1%. So when they're getting a lot of money on that 3-month, they're like, well, why would I go out and buy a 3-year, at a little less than 4 or at 4? Well, there's a reason for that, because eventually that 3 months is going to go away and you're going to need some protection short term. And that's why we look at it that way.
And in terms of duration, does it matter to you? Is it long or short duration?
Well, you need to know where you want to be on the curve. And I tell people this, that you can't if you wouldn't want to manage your risk, and I don't agree even with big bond managers on this, but if you want to manage your risk, you're going to have a certain amount that's less than 60 months, and quite a bit actually, so that you can manage the risk of rates going up and down. Because I think this coming decade will be one where rates will go up and down, up and down. If that's the case, you can't just decide to go out, well, I'm going to do a 15-year bond ladder and forget it. That will not work. You've got to move up and down the yield curve. And that's what we've been doing. We, a couple of years ago when things were just paying nothing, we brought a lot of bonds in short. This year we started moving some out long. And I think, we started setting some at 1 year, 2 year, 3 year. And we'll see if it works. Might be wrong, but if it is wrong, I only have to wait 1 or 2 years, if that makes sense.
We can all take a page out of Silicon Valley Bank's book, quite literally their book. They amassed a $124 billion bond portfolio, and apparently they didn't hedge against that. So when interest rates swelled up, that portfolio got wiped out, and people, you know what happened next. Yeah. What lessons can we learn from that, Ted?
Well, I think what banks should do, and this is a personal opinion, okay, but I think what banks should do is change their asset liability policy guidelines, where they say, look, we're not going to try to make so much money on bonds. We're going to try to make it on loans or other things, and we're going to keep those maturities short where we can control them, okay? And what happens, it leaves their control. And let's face it, a lot of people running bank bond portfolios, they're not really bond managers. They're just buying to try to get extra income for the bank. And to me, to take that risk when you've got a base of deposits that's just flighty at best, it really puts you in a bad situation.
I think the overall size of the bank is too small for regulators to actually check up on them. And I think that kind of flew under the radar. But yeah, a lot of people do agree with you that there should be some sort of change. I do wonder what's going to happen to this great reckoning that you're talking about. So over-levered assets are going to come down. You mentioned cryptos. You mentioned some risky stocks. Your fund isn't exposed to any of these sectors right now, I'm presuming?
No. In fact, we're only down to, we've owned real estate, and like in a publicly traded REITs, over the years, we've owned, 6, 7, 8 of them. We only own right now, and that's in that sector, we own Physicians Realty, which is nothing but doctors in offices, that sort of thing. And so we own Omega Healthcare too. It's a little bit more speculative, but a great dividend. And so we've really shied away from that because they kept falling in price. And the private people who are faking everybody out right now with no mark to market are eventually going to have to get in trouble too and have to sell some of those things. So a lot of that's coming, and I think it's too early for the REITs right now as far as that goes. We sold our energy last fall. We own the gas pipelines, oil pipelines. They'll do well no matter what because we get 7 to 10% on the cash flow. But I think most of the sectors, you want to be in the defensive sectors right now if you're looking to go that direction. That's where we are.
Defensive, like consumer staples, utilities, those sectors?
Well, we don't. I wouldn't say we don't own utilities. I'll tell you why. If you look at the average dividend on most utilities, it's not as good as a treasury. So that doesn't make sense to us, So we don't go nothing, and not that we have anything against them, but we try to compare the yields. Now we're seeing some really good yields in preferreds, particularly the big banks. I'm talking about the ones that are not going to fail. And those are, those are qualified dividends. So you only pay your 20% tax, just like you would on a stock. That's an interesting area right now because those are, over 6%, 6.5% or so. We picked up some Verizon at 7%. We picked up Kinder Morgan at 7%. We catch them on the lows is what we try to do. And, one of the things we're seeing, healthcare and the pharmaceuticals have really been under pressure. And if we may get a place in here where we'll add to that too. But we have a lot of things on the radar, just some of it doesn't hit.
With inflation having come down on paper, it seems that high yielding or any asset that generates a yield, those assets are becoming a little bit more attractive as the real yield goes up. Are you seeing any capital rotation into high dividends paying stocks or high dividend yield stocks like you mentioned, or perhaps fixed income assets more so than last year?
Not as much as you would think. Most of the new money that's driving in the market, some of it's going overseas, and some of it's going in to the big indexes, which have the big stocks. So we don't see as many people that are really out there trying to find. And I think cash flow will be really meaningful this next 10 years. People don't remember, but if you go back 100 years, 41% of the S&P return is in the dividend. And that's a lot, and so the dividends are down to nothing. So you're going to have to try to find things that do. But I don't think they're there right now, David, but we are.
Okay. Finally, let's talk about small businesses or the business landscape, and we'll close off there. The people watching the show, not everyone's an investor, though I guess the majority are, but a lot of people are small business owners as well. Walk us through, generally speaking, what's going to happen with our economy in relation to businesses. How should businesses prepare for this great reckoning? Any shifts in our economy and any shifts in interest rates that they should be aware of? Any shifts in the capital markets that they should be aware of? Basically, what should small businesses do to prepare for themselves for the rest of the year?
Well, David, I have a lot of respect for small business people because they're the ones that really hire the most people in this country, and they know what they're doing, most of them, not all of them, but most of them. But one of the things we track a lot is the National Federation of Independent Business, the NFIB, and I know you know all about them, but for all the people out there, they have one indicator, okay, that gives an idea. How do you feel about the future? Okay. Well, that's at a low. That's lower than it was right now in 07 and 08. And so I know these small businesses are not feeling great about that. Now, if I just stop and ask most of them, and I do this all the time, how's business? It's okay. It's not as good as it was last year. We're doing okay. Had to lay off one person, maybe, or haven't laid anybody off. And I noticed that if you look at the restaurant numbers, over the last 2 months, they've started to fade. They go from up 5 or 6 to down 3. Those are the things you watch in here with the small business owners. And if I were a small business owner right now, I would really clean it up. I would try to get that debt paid down. I'd try to, stack up my liquidity, and I would really try to notice what goes on, because if they have liquidity, there's a chance that they'll take really good market share when everybody else is in a hurt. And that's my recommendation to them.
You're right. The NFIB Small Business Survey Optimism Index has been coming down. It's been on a downtrend. There's a subset. They're asking businesses, are small businesses planning to hire? And the percentage has been declining. Back in late 2021, it was at 30 and 32%. Now it's come down to 15%. So declined by about half. So, relatively fewer businesses are planning to hire, which brings me to my final point about the labor market. The unemployment rate on paper, just the overall unemployment rate, is looking actually all right if you consider that it's at 3.5%, which is actually lower than the previous month. And so people are, at least legislators, are looking at that number and saying, well, that's not really a concern because the labor market's still good. We haven't officially entered a recession yet. Once we do enter this recession, what do you see this number going? Staying relatively the same, much higher?
Well, I don't know how much higher, but it goes higher because what happens is, if you look at employment right now, where everybody has a hard time with employment, everybody is in the jobs by the hour, the low end, where they need to hire people. And that's one of the things, that you have to watch for, because once business gets really slow and you start to lay off people by the hour. You have to remember, these people are living week to week. I've been there in my life. I know how they feel. And what happens is when that happens, you get really scared and then and it sort of grows on itself, and then the rate starts going up. People can't find a job. And now, I don't know the level necessarily, David, but I do think it goes up.
Final question I have for you, Ted. Goldman Sachs came out with a report last month, and they're predicting that artificial intelligence will lay off roughly 300 million jobs in the coming decades. It could also raise global GDP by 7%, they said, but 300 million jobs could be affected by AI, is their report. That's 18% of the workforce globally, and certain sectors will be affected more than others. Even in the journalism field, writers are being made obsolete because ChatGPT can write an article in 2 seconds. My question is, what are the skill sets that, for the younger people watching this right now, what are the skill sets that they need to develop in light of this AI revolution, and in order for them to be relevant over the next few decades and competitive?
Well, if I were a young person today, particularly between 18 and 30, I'll tell you a skill set they don't have, David. They've spent so much time in front of a telephone or a computer. They don't have a skill set of selling. Okay. And when I say selling, that's not marketing and that's not networking, but that's the ability to sit down in front of somebody, male or female, and say, hey, this is what we have to offer. It's great. And make a connection. Okay. If they are able to grab that skill set, I think that will really set them apart over the next 10 years, and they'll be highly sought after because so many of that set, okay, of young people don't have that skill set. They need it. I will tell you, and I've always said this, the number one salesman in any company, the number one, is the president. So these people in knock sales are not using their head, really. If I were a young person, I would develop that skill set to say, hey, you know what? I can get out, I can move around. I'm better than just a computer or a phone in my hand. And once you do that, I think owners and companies are going to notice you, and you're going to have a bright career.
Well, how do you convince somebody? This is veering off to a different topic, but how do you convince somebody to buy whatever it is that you're selling, whether it be an idea or a product or a service? What sets apart a very good salesperson from somebody who's not?
Well, I think what sets them apart is, first of all, you have to make a connection, a personal connection with anybody. Any deal you sell, any product that you're trying to sell to another company, you have to make a personal connection. You're rarely going to sell anything to somebody that does not like you, okay? And so we tell people that. I say, first of all, they have to like you, and you have to know your product. You have to know it really well, whatever it is. If you know it really, really well, that's going to be a good start for you. And I just see that particular age group, they have so much potential if they will reach in and do things. Yes, I think AI will be all around. I've already used ChatGPT in many areas just to try to see what it's doing. But I don't think that's the answer to a young person as their career.
Right. Okay. So develop not just hard skills, but social skills as well. Okay, Ted.
Well, I say that. There's just one more thing. I say that because I say this to everybody, but ChatGPT can't determine character. Just remember that.
Very few people can either.
Well, they can if they've been around a long time. They'll get there.
All right. Well, I appreciate your wisdom as always, and I'm sure our audience does as well. Thank you very much for your time today. Thank you, Ted.
All right, David. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.